then the chances are that a lot of this will apply to you. This is capital taxes. Capital taxes are inheritance tax or capital gains tax. They're the main two, and you will be affected by those whether you like it or not. So what we need to do is to make sure that if you do have to pay tax, you pay the least possible. Furnished holiday letting release. Furnished holiday let, just to recap. Firstly, the government lost it, they had a challenge in the European courts. Furnished holiday lets used to be just in England. Now they're extending that to the European Economic Area. That's bigger than the European Union, and it covers some far-flung destinations for most of these people who have holiday lets, like Iceland and Norway, some of these well-known locations. It doesn't cover the Canary Islands. It does cover part of Spain. If you take advantage of furnished holiday lets, you can actually give your property away for zero capital gains tax. How do you get a furnished holiday let? The rules at the moment are in their probably their last year before they change, but the rules at the moment are very simple. All you've got to do is have a property, and it could be somewhere in Bournemouth, you rent it out. And this is something classed different than a normal letting. It has to be available for 140 days a year, so it has to be available to be let out. It only has to be let out for 70 days, and it cannot be let out to the same person for more than 30 days. So you only really have to have 3 separate tenants in the year, and you qualify for a furnished holiday let. If you qualify, you can give that property away, say a sibling, daughter, son, whatever, and it maybe get zero capital gains tax, which is fantastic if you can make sure you qualify. So if you foregoed a bit of income on it, you could save an enormous amount of capital gains, because it's classed as a business asset. Normal letting isn't classed as a business asset. That's why it's important to bear in mind the furnished holiday let. That's the difference. So let's just go to an example. This is, all these examples are the type of things we come across day in, day out. In this case example, all it was one of my clients, fortunately he's divorced, got a daughter, his total assets are £1 million. His inheritance tax on that, because he's divorced, he's just got $325,000. That's the most that you can allow tax-free for inheritance tax upon death. So therefore, with assets of $1 million, he's going to be taxed on $675,000. The death rates are at 40%, so inheritance tax, he's going to pay $270,000. Well, the estate will actually suffer that, which means there's less money to go to his daughter. So he got one daughter, and he likes to look after her. So what that means is on his rental property that's worth $400,000, so that's $400,000 out of that £1 million, the tax on that will be at 40%. So that's $160,000. So he's a divorced man, 66 years old, one daughter, owns 2 properties. One property he lives in, one property is rented out. He owned the rented property for 15 years, but he used to live in it. Year 1 he lived in it, then he moved into his present house. So 2 properties, had a house, after 1 year, bought a second house, moved into it. So we've done the rental accounts for all this period of time. The current market value is £400,000. And he spent £50,000 on doing up the property. Now, we could have just stopped there, and some accountants I know would have stopped there, and that's fine. Because when he's dead, he's not going to start querying them, is he? And then they'll pay £160,000 in inheritance tax. But there is a better way. There's always a better way if you put your thinking cap on. And it's the better way that you need to think about. So how do we do it? Well, capital gains isn't always a bad tax, not if you know how to do it properly. So, £400,000 is, I put sales proceeds, it's not quite the right word. If you give a property like that away, the sales price is deemed to be the market value. So in this case, he gives it to his daughter. Because it's connected, it's a market price. If he gives it to anyone else, it's deemed to be the market price, because otherwise the revenue wouldn't get any money back. So capital gains is still levied even if it's a gift. So the $400,000 giving it to his daughter is when she sells the property, that's her deemed purchase price, even though he's giving it to her. Well, that's her deemed purchase price. And her father paid capital gains tax assessed on that deemed price. So So he won't actually receive any money about this, but the whole aim is to avoid his inheritance tax liability. If I can get it below £160,000, I'm doing well for him. And that's the idea. Now, when you do these computations, you can deduct your purchase price, 100,000. You can deduct the improvements, 50,000. You can deduct stamp duty on the purchase, and you can deduct legal fees on purchase and sale. So that is 153,000, takes us to 247,000. This is where it starts getting clever, because you deduct the period that you actually lived in the house. It was his principal private residence. And as I said, that isn't a typing mistake. He lived there for 1 year. But by living there for 1 year and electing his principal private residence, even though he's got two properties at the same time, the last 3 years of ownership are free from capital gains tax. So 4/15 of that, you don't pay capital gains tax on. So we deduct £65,000. So then we've gone from 400,000 down to 247. Now we're down to 181. But we're still not happy. We're still going to find something else. Let's get going to the next bit. How do we reduce it further? Well, because it was his principal private residence at some stage, and then because he subsequently rented out, you can claim a letting exemption. And it's the smaller of 181, 65 or 40. If he was married, then you could get 2 times 40, so that would be 80, even better. So he deducts the 40 from 181, take it to 141. As I say, if it was owned by husband and wife, it's not in this case because he was divorced. But if it was, that would be 80, and that would be 101. Everyone gets a capital gains exemption each year, £10,100. You either use it or lose it. If you don't use it, you can't carry it forward. You can just offset it against your capital gains. If it's got any losses in the year, you can increase that. Your losses you can carry forward, and you can carry forward them as long as you want. So anyway, claim the 10,100. That leaves me 131,000. What happens then is you have to pay capital gains tax on that. Now, the capital gains tax, there's 3 finance acts this year, so there's lots of bits of paper for us to read. But the point is that if we read it, we can give you the best advice. And what happens is that capital gains tax was at a flat rate of 18% up to June. That's fantastic. Labour government, 18% capital gains tax, lower than it had been for years with Nigel Lawson. In June it was increased to 2 rates, 18%, 28%. 18% is levied if you're a basic rate taxpayer and your income and gains are in the basic rate tax band, i.e. about £44,000. So that means that anything above that, you're already going to be into 28% capital gains tax. So 28% is the figure it's going to be levied on. 28%, 131, means you've got a tax bill of £36,000. Bearing in mind the property was worth £400,000. So that's under 10% tax. Now, if I take you back to what we first started with, what we first started with was a potential tax bill on £400,000 at 40%. That's what inheritance tax would be levied on. So that means that we've actually managed to save the client £140,000 minus 40, so over £100,000 in tax just by that planning. If, as I explained here, if there was, he was a widower and his wife hadn't used her inheritance tax exemption, he would have £650,000 free assets. In this case, he can't use that. You don't incur any stamp duty because it's a gift. Stamp duty is paid on gifts. So there's no stamp duty. As I said, it's because the gift is between connected parties, the market value is the sales price. So £400,000 is it when his daughter comes to sell the property, that's her base cost for sales. And he only lived in the property for 1 year, but we're claiming 4 years exempt from capital gains tax. That's because we claim what the papers call the flipping, which is an election from principal private residence, which you can do perfectly legal, but as I say, roll up, Vince Cable said he's going to get rid of it. If you look at the Sunday Times yesterday, there's even more information on that. So you better get in quick. If it was jointly owned, it's 80,000, not 40,000. Husband's got a capital gains exemption every year, which we've used up. Saving is 123,000, 160 minus 36. There is a better way, ladies and gentlemen. That's the example of it. Now, what do we do if we want to tweak this? You can always tweak it, and the point is that your situation may be slightly different. Like the daughter now gets all the rental income, and the father says, well, I need some rental income. You could give her part of the property, you don't have to give her everything. The father doesn't want the daughter to sell the property. I had this situation before where he said, look, she's too young, I want to mitigate my inheritance tax, but I don't want to give her a property, and I'm worried she might just flog it and put it all on black at the casino or something. Well, the father could still retain an interest in the property so that she can't sell it. So there's ways of dealing with that. That will give you an idea of how to mitigate those type of situations. But another day, another client, another problem, and this one I deal with completely differently. This one is inheritance tax problem. Husband and wife pensioners. They own their own home. They own 3 rental properties. Don't have any additional income. They've got pretty enormous IHT liabilities. They've got 4 properties there, and they need the income to live on. If they gave the rental properties to the children, we go back to what we first started with, and we'd have a capital gains tax bill. We could mitigate it. This is a different situation. The tax liabilities will be a lot bigger, and they haven't really got any spare cash. So what I suggest is what's called the family debt scheme, and you will be surprised how easy this can be if you know what you're talking about and how to do it. The problem we've got is you cannot hold over the capital gain. What I mean by that is you give a business asset to someone, then you can make a holdover relief, which means that you don't pay capital gains tax, and you give that asset to someone and they receive that asset at your base cost, and you don't pay any capital gains tax. Rental properties are not business assets. You can't do that, you can't make a claim, hence you've got a big tax bill. How do we get around it? Second problem, that's the only income for that husband and wife. They've got nothing to rely on. They need the income, but they don't want the properties, because they want to avoid the IHT. Well, do you want your cake and eat it? Well, you do, yeah. Can they do it? Yeah, we can, because we've got a way around it. The way we do it is the client, it doesn't matter whether the husband owns the properties and he sells them to the wife owns the properties and sells them to the husband, or they're joint owned 50-50 and they sell the other half to them. But what you're doing is you're moving the assets around and creating a liability. So let's just assume the simple way, 3 properties in husband's name, wife hasn't got any rental properties. What do? You can sell them at market value. Why doesn't that give you a capital gains bill? Because between spouses, capital gains tax doesn't crystallise. It's a transfer, no gain, no loss. So you don't actually give rise to a capital gains tax bill, don't give rise to any crystallisation. Well, how does that help us? Well, if you sell it, you've got a debt. So you just forget it's the wife, you're selling to a third party. But the reason it is the wife is we can avoid the capital gains tax, but we can crystallise a liability. So I've got a property of £1 million, sell it to my wife, she owes me £1 million. Now, there is a way of doing this, and the reason the way of doing it is because we want to do it that way. We want to create £1 million, because then there's a debt. What do we do with the debt? Well, you give the debt to the children. So you've got a property of £1 million, but you've got a debt of £1 million. And the debt is owed not by Barclays Bank or someone like that, it's owed by the children. Then you've got a property that's encumbered that was previously unencumbered.
It'd be nice for the kids to get debt from you rather than the other way around.
It is, but it's also nice that they ain't going to pay inheritance tax on £1 million. That's the beauty about it. So, the sale of the investment property to the wife, no gain, no loss. The reason is, as I say, transfers between spouses don't crystallise capital gain. Gift of the debt to the children, potentially exempt transfer, that's a pet. PET, not one that runs around on four legs. As long as the client survives 7 years, no IHT consequences. Downside is, unlike the first one, because it's a gift, this isn't a gift, therefore SDLT kicks in. Another roll up, ladies and gentlemen. Do it now before your SDLT rises, depending on the value of the property. I would suggest that's a small price to pay for paying 4% SDLT to save 40% on IHT. Just repeat what I started with. There is another way. There's a better way. You might pay a bit of tax, but it's downside better than 40%. Just think over shares. Can you do it with shares? Yes, you can. It doesn't have to be property. And if you did it with shares, the SDLT will be less. Effectively by transaction, client's wife owns the investment properties, they still get the income. The income still comes from them, so nothing changes on that front. The debt is held by the children, so you're just moving the value of the equity out of the estate. Now, the bits that may be useful for this is that how does this work? You may have come across gift with reservation. Gift with reservation is the type of thing that inheritance tax is tackled by the revenue. And what that means is that you can't make a gift to get it out of your estate and still have the benefit of it. So a gift with reservation, for the sake of argument, is that you can't have a memoir sitting in your dining room and say, I'm just giving that to my daughter. The revenue say, well, you just get the benefit because you're still looking at it every day. So a gift with reservation has no bearing from inheritance tax. The reason this works, it's not a gift, it's a sale. The other thing is you may have come across is a pre-owned asset test. Pre-owned asset tests also is for inheritance tax. And this is also avoided by this. The A, because it's a sale, but also because of the husband and wife rule. So, with all these things, there is a better way. And as I explained, this lecture comes with a guarantee that you get a refund of your attendance fee for today. You didn't get something out of this lecture. So we've got some literature, because I know I went through that quite quickly. Is there anything you'd like me to explain? Any questions, comments?
On the first one, does it mean that the father in this case has to pay that reduced tax at the point of selling or transferring the asset to his daughter, as opposed to paying that tax when he's dead?
Well, let's do it in reverse order. The estate pays the tax, and the estate would have paid 40% of 400,000, 160,000.
Right.
With this, good question, that does have to be paid, yes.
By him at the time transfer?
No. What happens if the father didn't have much money and you wanted to do it? Other things being equal, I would suggest, for the sake of argument, 10th of April 2010, a good time to do it. Why? Because you're into the new tax year. 10th of April 2010 for the transfer. When do you pay the tax? Any ideas? January what?
11.
12. 31st of January 2012. You nearly got 21 months there to do that. 21 months. Well, how can I get the money? Well, I can borrow the money from my daughter. She's got rental income for 21 months. She might not have any other income. She may be a student. So therefore, perhaps she can take advantage of her personal allowance. She's got a basic rate tax benefit. I might be a high rate tax. I may be suffering 40% of my income. She might be coming out quits in on this. So I could borrow it from her, raise some more money. She could get a mortgage out on the property, pay me back. But I've got 21 months to find that. You can stagger it. You can find a way. But in answer to your question, yes, it does have to be paid. And the question is, would you rather pay only 7,000 now or 100?
Well,
50,000 later?
now I'm living, the other I'm dead.
Well, I started off by saying it's mitigation. You're going to have to pay some tax. It's just a case of how you pay it, when you pay it. No one's got a crystal ball. There are ways to the extent you don't have to pay as much.